So I'm still on my sort of Sunday weekend attire. I was feeling kind of bad about that until I ran into Michael Batnick of Ritholtz Wealth Management. He's wearing shorts, so I'm feeling a little bit better. So before I get started, let me say a little bit about myself. If you recognize me, and you don't need to recognize me, it's probably from my previous incarnation. I was the portfolio manager for the PIMCO All Asset Fund, and later on the co-founder of Research Affiliates who brought you the Fundamental Index. But today I'm speaking to you, representing my third act. I'm now the founder and chief investment officer of a ETF shop that specializes in emerging markets and China ETF. So emerging markets. A lot of people research it. I can tell you I live it. I was born in 1974. At that time, my mother made $20 a month, so about 240 bucks a year. That's in 1974. By 1985, that's when we decided to immigrate from Taiwan to the US. Now you can imagine, how does a person making about $200 a year immigrate to the US? Well, by 1985, my mother was making about $20,000 a year. So it's sort of a growth of 10x, no, 100x in annual income over the span of 10 years. And also, over that time, interest rate in Taiwan dropped from 16% per annum to closer to about 6.5% per annum. And as a result of that, real estate went up about 20 times. Roll the clock forward a little bit. By 1992, when I was going to Caltech to get my degree in physics, she had, by that time, become a housemaker, taking care of me and my sister in the US, and became a day trader of sort. She was very lucky because during that time period, stock market in Taiwan, it went up 10x. So she was doing L investing before there's L invest. And importantly, because of that raging bull market in Taiwan, she fashioned herself a little bit like a female version of Warren Buffett. And that point is going to be important as we talk about retail trading in emerging markets more broadly. Today, Taiwan makes most of the components inside your smartphone, your iPad. When I was growing up, my favorite pastime with my granddad was he would take little pet projects from the factory, and we would build hairbrushes together. That was what factory work was like when I was growing up. Yes, my colleagues are wondering why I was carrying a comb in my pocket. And so that was the story and journey of Taiwan. It is not an isolated incident. My wife, I married a woman from China, so how's that for a little Taiwan-China reunification? She was born in the city of Wuhan, which is now known as the home of the coronavirus. Growing up, the city was so poor, there were no cars in the city. Wuhan is actually also the oven of China. That's how hot it is. So they would all, at night, move their little bamboo pad and sleep in the middle of the street to cool off, because there are no cars. And today, China has just crossed Germany, and it's only second to Japan as the biggest exporter of automobiles. And when my wife first came to the US, so she applied and got into Wellesley at the time when they took in 2 foreign students a year, and the only way she could afford to study abroad was to be not just the number one at her school, she was like number one in her province. So she's actually the smart one in my household. And they had to borrow money to get her on a plane to come to Boston. And today, most universities in the US regularly depend upward of 20% on foreign Chinese students who are happy to pay $65,000, $80,000 a year to come study in the US. And many of them at NYU living in a pad that costs $10,000 a month in rent. right? And China today is one of the biggest consumer of luxury goods. That is the story of emerging market growth. Now, I'm not going to tell you because I live it, I'm therefore a better researcher. In fact, quite the opposite. I am a prisoner to my experience. Many of you probably came from an emerging market or know someone who came from an emerging market. And it seems obvious to you. Isn't every emerging market going to be like a Taiwan, like a China, a South Korea? It's so clear, right? This hungry young workforce opening up to do global work, accumulate wealth through exporting, and eventually with that massive wealth, develop a big domestic consumption market. And then the housing market rallies and the stock market rallies. And the question for global investors is, how do we get in on that? How do we participate? It seems so obvious that investing in EM would be the right move. Not just as a portfolio diversifier, but really as a way to capture that massive growth engine. And as I said, we're prisoners of our experience because that is not what actually happened the last 10, 15 years if you were invested in emerging markets. What did you get? You got 15 years of disappointment. The return wasn't there. You saw the faster GDP growth, but somehow that didn't translate into returns. And you thought, okay, maybe I can fall back on diversification, right? When return doesn't work out so well, you can always say, diversification. You didn't even get that. Emerging markets ended up being a high beta market. When US catches a cold, EM gets a flu. When there's a flight to safety, EM has a currency crisis, right? When the US consumption falls, these heavy export-dependent economies like South Korea, like Taiwan, export craters, and they have a little recession. Have we been wrong about EM investing? Have we been wrong about the growth thesis? Or are we doing it wrong? Why hasn't traditional EM investing worked? Let me show you some slides. This is the only graph I'm going to show you today. So I just published this paper with my co-author, Dr. Phil Wool and Dr. Jay Ritter. First and foremost, there is a big mystery in emerging market growth literature that says the GDP growth of an economy you invest in is uncorrelated with the stock market return. That is, we can stop being fixated on, whoa, is EM going to grow faster? Completely immaterial. Over the long horizon, I think this is a laser. Right? Over a long horizon, there isn't much of a relationship outside of China and Argentina being the positive and the negative outlier. Why is that? How is it that the underlying economy is growing, but yet when you participate in that market, you can't capture the return? Well, that's because we've been lazy. If you look deeper into, say, the MSCI or the FTSE EM basket, what you'll discover is that you're not buying the growth engine of emerging markets. By and large, what you're getting exposure to is a lot of state-owned enterprises, and that's certainly not the growth engines you think about. And you're buying a lot of mining, these cyclical boom-bust cycle that are these giant state-owned mineral resource companies. How did that happen? How do we construct the beta so wrong? Part of this, for companies to get big enough to list, You need a vibrant venture capital and private equities market, right? You need capital to incubate private enterprises, to take a mom and pop liquor store to become a Walmart, or to finance a Jack Ma into an Alibaba, right? Otherwise, Jack Ma would still be a high school teacher, right? So you need a vibrant VC and PE market to incubate entrepreneurs. And that by and large is actually not available in many of the emerging markets. And again here, China being the outlier, because China surprisingly actually has the world's second largest VC and PE market, entirely thanks to the Yale endowment for bringing that to China. In addition to that, you need to have financial institutions like a well-regulated, well-managed stock exchange that have sensible rules that takes the barrier to entry of becoming listed and reducing that cost. Again, by and large, you don't see that in many emerging markets. It's just not worth the effort to be listed for some of the smaller growing companies in the emerging markets because of the bureaucratic red tapes. Right? So that's really important to understand, can you actually buy that growth? And you also want to think about earnings growth. But the whole thesis of investing in emerging markets is to go and buy the earnings growth. And why do we think there's going to be earnings growth? Well, we hear about the demographics bonus all the time, right? And what is the demographics bonus? The thesis is you got hungry young men who want to work cheap. And that is going to drive corporate profit when you open up to trade at global prices. Simple thesis to understand, except it's not so simple. Until you have a functioning government that builds road, port, infrastructure, so that foreign capital would come in and set up factories and then technology transfer and train your workforce. Until you do that, it is not such a good idea to have a bunch of hungry young men sitting around, because they'll mostly just be hungry. When you have hungry, unemployed young men, they generally just get angry. And that's not what drives growth, right? It's really important to understand, do you have the conditions there for sustained growth? And one of the big mysteries in emerging market growth research is, why do some countries, particularly the Asian emerging markets, emerge? And why do some of the, say, more resource-oriented Middle East, Latin, why do they not emerge and mostly go through cyclical boom-bust cycles? And that's really useful to understand. Correlation. Why are so many emerging markets so correlated with the US? Well, first of all, if you haven't grown, haven't accumulated wealth, and you're dependent on foreign capital, case in point here, Argentina, then you'll always be heavily dependent on US capitals. Whenever there's a financial crisis in the US, you're going to be a high beta exposure and you're going to have a currency crisis. That's because you're too dependent on the dollar. Or if you never decouple gradually from the US as an export-oriented economy, like a South Korea, like a Taiwan, where both of them still 40% export, then you're going to be very heavily dependent on US consumption. So it's important that as you accumulate wealth, you translate that into a vibrant domestic consumption economy. Which countries have that? It's important to understand. Otherwise, you're not going to benefit from this decoupling and the low correlation. So don't think of decoupling as a bad word. Decoupling is just a natural progression as you evolve and accumulate wealth. That has to happen. It's a good thing. That's how you get the low correlation. And finally, why haven't we seen the alpha? Right? This is a very inefficient market. Right? Immature young market should have lots of alpha. But alpha in EM portfolio management has been rather spotty. Why? Because alpha is a zero-sum game. It has to come from someone. It's not enough that you have a market that's inefficient. What you need is an inefficient market that is dominated by retail trading, because they are your alpha reservoir. And to have a lot of retail trading, what do you need? you need to have quite a bit of accumulated household wealth. That is, not only does per capita GDP have to grow as countries export, learn a skill, and earn dollars, they also have to save it and then go into the stock market. Your alpha comes from whom? Comes from people like my mother. So once you understand all of that, you start to understand why traditional EM investing hasn't worked. We've been lazy. We haven't think about it carefully enough as to what we're buying when we bought a passive MSCI EM or a manager that's tightly tracking that. Earnings matter. It's not the GDP. Market inefficiency isn't enough. You need to have a high degree of retail trading. Right? So if you're investing in Mexico, if you're investing in Russia, where there isn't household wealth, right? Those markets are inefficient, shallow, and expensive to trade in, but you're not going to extract alpha because that's going to come from somewhere, right? You got to look into markets like a China where it's 90% retail trading, or Taiwan and South Korea that after 60 years of, after 30 years of being included in MSCI is still 50, 60% retail trading. And to get uncorrelated return, you got to look for a market that's not so dollar dependent in their financing and not so export dependent. So what is the right way to do EM? First of all, as I mentioned, don't be lazy. Right? If you just buy a passive benchmark, all of the issue I just described is all right there. Right? There's a false assumption of GDP growth will get you return. That is not true. There's a false assumption, the biggest companies there are like the big companies in the US that drive the GDP, drive the growth. Not true. The big companies in those economies oftentimes either are the biggest bubbles or they're the giant state-owned enterprises and they're not very good for you. Right? So it's really important to understand what actually drives results in EM. Before I conclude, I am bullish on EM. And specifically, we like China quite a bit. Why is that? Is it so naive as to be, EM is cheap right now? It's a record low price-earnings ratio versus itself, versus other countries. No, I'm not so naive. When you look at a low valuation multiple, instantly you think to yourself, is it a value trap? Is it just distress? I'm not tone deaf to the fact that there is a US-China tension, and China is 33% of EM. If China invades Taiwan, China plus Taiwan together is 46% of EM, and there goes your return, right? But our assessment is that it's a low probability event. But you're earning an enormous optics risk premium. So it's not real risk. It's a career risk. It's an optics risk. It is what gives you a premium without the actual risk. But yet, optics risk, from the client's perspective, is business risk to yourself. And that's important for you to think about. Lots of questions about EM. Right? Is this the right time? Is the valuation low enough? Is the demographic issue too long out in the future for you to worry about? Or is that going to get priced in soon enough? We'll have we have answers to many of your questions. Come find us, either outside in the Great Hall or by the Cabana. Love to speak to you more about our views and our research. But I think my time is up, and let me give the microphone back to our host.